93%. That's the combined ratio the U.S. property insurance industry posted last year. For every dollar collected in premiums, 93 cents went back out in claims and costs. That's not a casino number. It's not a sports book. It's the policy sitting in your name right now, the one you renewed without really reading, the one you assume is there in case something goes wrong. By the end of this, you'll know 3 numbers. All 3 are about you. The first one is the one that makes this whole video, and it's coming. Here's what most people believe. Your premium is set aside for you personally. A kind of private fund waiting in case the storm comes. If it never does, you figure the insurer just held your money and gave you the peace of mind for free. You've done this. You opened the renewal letter this year, saw the new number, and paid it because the alternative was no coverage at all. And that's not really a choice. Maybe you called and asked why it went up. Maybe you didn't bother because you already suspected what the answer would be. Everyone's number went up. There's a number for this. A real one from one of the largest insurance operations on earth. We'll get to it. It's the one that makes this whole video. Here's what the numbers actually say. Your premium doesn't sit in an account with your name on it. It joins a pool, yours and a few thousand others just like it, spread across a state, sometimes across the whole country. Let's make it real. An actuary looks at a group of houses similar to yours, estimates how many will file a claim this year, adds a margin for cost and profit. That's your premium, not a guess. A formula run against the group, not against you individually. Your specific house, your specific roof, your specific bad luck, none of that is the unit the formula is built around. The pool is the unit. Okay, so there's a pool, there's a formula, fine. That's how insurance is supposed to work. Nobody's shocked yet. Here's the part that isn't in the pamphlet. The moment that pool exists, it gets invested. Bonds, markets. While your claim, if you ever file one, is still months, sometimes years away. You see a premium. The system sees float, capital it's legally allowed to hold and invest before it ever has to give a cent of it back. And it can hold that money for a long time because most policies in most years never generate a payout large enough to touch it. And this is the part that actually changes the story. When you file a claim, the payout isn't your premium coming back to you. It's the pool's money filtered through a deductible, through depreciation, through whatever the policy specifically excludes. The number you expected and the number you get are rarely the same number, and the gap between them is where the fine print does its work, not an accident. Pooling only works mathematically if enough people pay in and relatively few collect the full amount. Nobody built this to trick you, specifically. They built it so the math survives contact with an actual hurricane, and that's a different design goal than make sure you personally feel taken care of. State regulators approve every rate filing. That part is public, and the rules can move fast. In Florida, insurers now have 60 days to decide on a claim, down from 90. Homeowners have 1 year to file, down from 2. Both changes came within the last 2 years. 2 years ago, you had twice as long to notice storm damage and get a claim in. Today, you don't. The clock on your claim got shorter, not because storms got smaller, because the rules did so. The pool takes your money, invests it, pays out through a filter. Now let's run the numbers. Let's make it real. You put in $100. On average, about 93 of it goes back out in claims and costs industry-wide. That leaves 7 before a single dollar of investment income is even counted. Now, in 2025, the U.S. property and casualty industry posted a 93.0% combined ratio. Its lowest, meaning its most profitable in over a decade. Whatever you personally pay in premiums each year, that same ratio applies to it. Roughly 93 cents of every dollar goes to claims and costs, and the rest becomes the industry's cushion before the float even gets touched. That's the baseline. Everything after this is on top of it. Let's make it real a second way. Imagine the money isn't spent the second you pay it. It's parked, earning interest, waiting for a claim that might not come for years, if at all, and every year it waits, it's working somewhere else for someone else's benefit. Now the real one. Berkshire Hathaway, one of the largest insurers on earth, held approximately $176 billion in float at the end of 2025, up from $171 billion a year before, up from $88 billion a decade earlier. It doubled. Not mostly from new customers. From time, every policyholder's premium sitting working, the whole time nothing happened to them personally. That's 10 years of ordinary people paying ordinary premiums and none of that money sitting idle for a single quarter. Keep that one. Let's make it real one more time. If nothing dramatic happens to you this year, no claim, no storm, your premium simply becomes profit for the pool. That's not a failure of the system. That's the system working as intended. The quietest year of your life is structurally the best possible outcome for the business you're paying into. Now the real one. The industry moved from an underwriting loss in 2023 to a $23 billion underwriting gain in 2024 to roughly $63 billion in 2025, nearly tripling, largely because it was a quiet hurricane season. For you, that means the calmest year of your life was also the industry's best year on record. 1 year. Record profit. And nobody's roof came off for it to happen. There was no headline event. Just an ordinary, uneventful year multiplied across millions of policies. Every figure so far comes from public, filed sources. Fitch Ratings, AM Best, and Berkshire's own 2025 annual report. They're linked in the description if you want to check them yourself. It's not that the industry expects you to file a small claim and quietly disappear. It's that the math was never built around any one policyholder winning or losing. It's built around the size of the pool. Whether you specifically come out ahead was never really the design question. And once you see that, a lot of the fine print stops looking like an accident and starts looking like a load-bearing wall. State insurance commissioners approve every rate. Combined ratios are filed in statutory reports every year. This isn't hidden. It's regulated in plain sight. Legal doesn't always mean it feels fair. This is one of those cases. Here's the irony. The year insurers advertise the most reassurance, we're here for you, we've got you covered, is the same kind of year, a quiet one, that makes them the most money. The calm isn't the exception to the business. It is the business. And the rules can move against you fast. Florida cut its claim filing window from 2 years to 1, and its insurer response deadline from 90 days to 60, both inside the last 2 years. Not because the risk changed overnight. Because the rule book did 3 numbers. All of them yours to keep. Insurance doesn't bet against the storm. It bets that your money is worth more sitting still than it ever would be in your pocket. 3 things to know. Not to do, to know. 1. Combined ratios are filed with state regulators every year, and the industry-wide number is public. Under 100% means an underwriting profit. 2. Non-renewal decisions are often made pool-wide, based on regional risk, not your individual claims history. Your own record can be spotless and your coverage can still disappear because of what's happening 2 counties over. 3. Claim filing deadlines are set by state law and they can shrink. Check your state's current window. Don't assume the deadline you remember is still the one that applies. That 93%. You already met it. You just didn't have a name for it. The math always wins. Now you know exactly where it's sitting.